Here's a number that stopped me the first time I saw it. The average U.S. investor holds about 82% of their equity portfolio in U.S. stocks. 82%. Now compare that with this. The United States currently represents about 62% of the global stock market. So investors aren't just owning the market. They're overweighting their home country, often by a lot. That gap has a name: home bias. And the interesting thing about home bias is that it doesn't feel like a mistake. It feels smart. You understand American companies, you use their products, you read about them every single day, and you've watched them dominate headlines for the past decade. There's familiarity there, and familiarity feels like safety. But familiar and diversified are not the same thing. Let me make this real. If I had to describe the average portfolio I review right now, it usually looks something like this: an S&P 500 fund, a growth fund, maybe a NASDAQ ETF, because tech has done so well. Then RSUs layered on top of it if the person works in a public company. Different funds, different tickers, different account statements. But underneath, the exact same bet. U.S. large cap growth. And often it's the same handful of mega cap technology companies driving a big portion of that exposure. Now, to be clear, the U.S. has been an incredible market. It's been dominant for over a decade. But markets, they move in cycles. And one thing I've learned watching markets over the years is this: the biggest risks in portfolios rarely come from bad investments. They come from good investments that worked for too long. Because when something wins for 10 plus years, people stop asking questions. And that's usually when concentration risk quietly builds. And right now, a lot of the portfolios are sitting right in that exact same spot. When we come back, I want to show you why this is happening and what the valuation data is quietly telling us about global markets.